Welcome to Breaking News to Trading Moves. Today, we are going to look at Marvell Technology's recent stock drop, even though they reported really strong AI-driven growth.
Right, yeah.
So the mission for today's episode is to examine this headline and then break down exactly which companies fall into the winners and losers categories based on this information.
Yeah, it's a really good topic. The core event driving that drop is that investors basically zeroed in on the timing of revenue from a custom AI chip agreement with Alphabet's Google.
Okay, so the timing was the main issue there.
Exactly.
Mhm.
Marvell's management indicated that the Google relationship only becomes highly material in fiscal 2029.
Oh, wow. 2029. So it's kind of like an athlete signing a record-breaking contract today, right?
Yeah, that's a good way to look at it.
You know, everyone celebrates the headline number, but the actual paychecks for those later years, they don't start clearing the bank for another 5 years.
That is exactly it. The market is becoming acutely sensitive to exactly when these AI contracts translate into actual revenue and earnings. High expectations were already priced in. So it proves that a large contract does not automatically equal an immediate earnings catalyst.
Makes sense. So let's move directly from that headline's focus on Marvell's delayed revenue to the broader categories of companies facing pressure from this development.
Right, the losers here.
Yeah. So category one is high valuation custom silicon stocks. And we're looking at MRVL, Marvell Technology, and AVGO Broadcom.
Yeah, and Marvell is obviously the clearest near-term loser here. But the problem isn't weak demand.
Okay.
It's simply that investors had already priced in the expectations from the Google agreement. Investors are now, very closely examining when announced AI opportunities will actually become material revenue.
Got it. Well, category two is a general-purpose AI accelerator companies. We're talking NVDA, NVIDIA, and AMD advanced micro devices. Now, I have to challenge you a bit on this one.
Okay.
How can dominant players like NVIDIA possibly be categorized as losers when the AI market is expanding as fast as it is?
It's a fair question. But relying strictly on the text, while overall AI infrastructure spending is expanding rapidly enough for multiple architectures to grow simultaneously.
Meaning NVIDIA and AMD don't suddenly lose the AI cycle.
Right, exactly. But hyperscalers wanting more custom silicon represents a long-term competitive threat to their share of that specific hyperscaler spending.
Ah, I see.
Yeah. Every workload moved to an internally designed chip potentially reduces what cloud companies spend on merchant accelerators.
That makes a lot of sense. So that brings us to category three, which is AI server vendors,
Mhm.
like SMCI, Supermicrocomputer, and DELL, Dell Technologies.
Yes. A move toward customized hyperscale infrastructure really changes how AI servers are designed and purchased.
Right, because these companies have benefited from demand for systems built around third-party accelerators.
Exactly. So proprietary chips introduce a new competitive variable for them.
Okay, well, having covered the companies facing pressure from this push toward custom silicon, let's pivot to the companies actively benefiting from this exact same trend.
The winners.
Right.
Yeah.
Category one, hyperscale cloud companies. GOGL, Alphabet, and MSFT, Microsoft.
Designing specialized chips offers them much better economics,
Okay.
and it gives them greater control over performance and power consumption, plus reduced dependence on a single semiconductor supplier.
Oh, right. So it gives them greater control over one of their largest AI infrastructure expenses.
Precisely.
Category two is semiconductor design software and tools. We're looking at SMPS, Synopsys, and CDNS, Cadence Design Systems.
Mm-hmm.
It's kind of like the picks and shovels approach of the gold rush, Like,
Yeah.
you don't have to mine the gold if you're the one selling the tools to everyone else.
That aligns perfectly with the text. Every new specialized accelerator requires sophisticated design, verification, and development tools.
Right.
So these software companies benefit regardless of which individual accelerator ultimately wins.
Yeah, that's a great position to be in. Category three is AI networking and optical infrastructure. ANET, Arista Networks, COHR, Coherent, and LITE, Lumentum.
Yeah, and this is because large AI clusters require much more than just processors.
Right. They have to communicate.
Exactly. They need high-speed networking, optical connections, and really complex data movement between thousands of chips.
Okay, so to bring the discussion back and just sort of summarize the overarching lesson for the market here.
The new market reality is that investors are no longer rewarding AI announcements automatically.
Right, traders are now demanding answers to some very specific questions, like when does the revenue actually arrive?
Yes.
How much is already included in guidance? What margins will the business generate? and how much growth is already reflected in the valuation.
Those are the exact questions they need answered now.
So I want to leave the listener with a final thought to ponder based on the material we covered today.
Okay.
If the timing of revenue is now the market's primary obsession, how will the entire hardware landscape adapt as we actually approach fiscal 2029 when these large custom silicon projects are fully operational?
It's definitely something to watch.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.